Ladies and gentlemen, federal employees, today we're talking about when the government is going to start forcing you to pull from your TSP, your traditional TSP, whether you want to or not, because by golly, they want the tax revenue and they want it exactly when they want it. And we're going to talk about when and how that's going to apply to you. Again, we're talking about RMDs, required minimum distributions, when you're forced to pull money from retirement accounts, that regardless of whether you want to or not. Long story short, the age that you're forced to take money out depends on when you were born, because it's changed over time. It used to be 70 and a half, 72, 73, it's going up to 75. Long story short, it depends on when you were born. So if you were born before July 1st, 1949, you started, this has already happened for these people, at 70 and a half. Okay, that was the initial RMD age. And if you were born, though, anytime between July 1st, 1949 and the end of 1950, the age for you, of course, went up to 72. And if you were born anytime between the end of 1950 and 1959, basically the end of that, your age, of course, is going to be 73. Okay, that's when it's going to hit for you. And people in this range are some of them haven't hit RMD age yet, right? But it's going to be 73. This is technically what they call the current RMD age, because people are starting to hit this now. But if you're born 1960 or later, it's going to be 75 for you. Now, what does RMDs even mean? So let's do an example here. Let's say you've got your TSP here, and let's say it's all traditional. You got no Roth money in there, it's all traditional. At whatever age your RMDs start, again, the government's going to say every single year, they want you to pull money out of your account regardless of whether you want to or not, okay? And the amount depends on your age, okay? As you age, they want more and more out. And it's a percentage. It's based on life expectancy table, so it fluctuates a little bit. But long story short, let's do an example. Let's say you're 73, okay? And this is the first year you take RMDs. Let's say they want you to take out 4.5%, okay? And that's kind of roughly where I see these start, roughly-ish. There's RMD calculators out there, you can check it. So maybe at 73, they want 4.5%, and then the next year at 74, maybe they want 5.5%, and it would kind of go up like that over time. Now, again, look at some calculators for your age and your gender. But long story short, that is roughly how it works, depending on when it starts. And once it starts, once you're forced to take money out with RMDs, you got to take money out every single year based on, again, there's calculators out there that'll show you how much you want to take out. Because at the end of the day, the government doesn't want you to keep money in pre-tax accounts forever. Now, one thing I will note is Roth accounts are exempt from this rule. So if you have Roth TSP, Roth IRA, you do not have to take RMDs on those accounts. It's only for pre-tax retirement accounts like traditional TSP, traditional IRA, that RMDs are going to be applicable. Okay, so I hope that's helpful. Hope that gives you an idea of when RMDs are going to hit for you, and I'll see you guys next time.